All right, let's get right into it. The world is on edge. There's a major war in the Middle East, tankers are getting hit, and markets are, well, they're in chaos. Now, this is supposed to be gold's moment to shine, right? But it's not. It's crashing. So today, we're going to break down this powerful, kind of hidden force behind the collapse, something called the national margin call.
I mean, this is the big question, the one that is pretty much everyone's scratching their heads. For decades, the playbook has been super simple. Geopolitical crisis hits, people run for safety. And what's the ultimate safe haven? Gold. But this time, it feels like someone's thrown the playbook out the window, because we're seeing the exact opposite happen. And this slide just lays it out perfectly, doesn't it? On the one hand, you have the expectation, this core market rule we've all lived by. And on the other, you have the brutal reality. Gold, the ultimate safe haven, isn't just failing to do its job. It is actively tanking at a shocking speed.
And look at the scale of this thing. We're not talking about a little dip here. We're talking about a 15% drop in a single month. After an absolutely incredible run-up, gold just fell off a cliff. So what gives? You hear the financial media talking about profit-taking or technical corrections, which, let's be honest, is basically just code for we have absolutely no clue what is going on. But here's the thing. While most of the market is flying blind, the data is finally starting to tell the real story. We now know who at least one of these huge mystery sellers is, the one that just flooded the market with tons and tons of gold. And their story, you'll see, is the key to this whole puzzle. The sheer volume of this selling is just stunning. In just 2 weeks, Turkey dumped 58 tons of its gold. Now, to put that into perspective for you, that one country's selling was more than all the gold that flowed out of every single gold ETF on the planet combined. This was not some strategic portfolio tweak. No, this was a forced liquidation, plain and simple. And that right there brings us to the core theory, the idea that really explains everything we're seeing. It's a concept that completely flips the safe haven idea on its head. It's called the national margin call. Okay, so here's the bottom line. You know how a trader can get a margin call from their broker and they have to sell stocks, like right now, to cover their losses? Well, imagine that happening to an entire country. They get margin called. They are forced to sell their best assets, in this case, gold, not because they want to, but because they desperately need cash, specifically US dollars, just to stay afloat. So let's dig into our first case study here to see exactly how this plays out. And Turkey, well, Turkey is a perfect and really painful example of an energy importer getting slammed with a massive, unexpected bill that completely forces their hand. Just look at this dependency. It's huge. Turkey imports 90% of its oil and an absolutely staggering 98% of its natural gas. So when this war kicked off and oil prices shot through the roof, their energy bill just exploded. Think about it. For every $10 increase in the price of oil, Turkey has to somehow come up with an extra 4 to 5 billion US dollars per year. So this left the entire country backed into a corner with three and only three truly terrible choices. Number one, let their currency, the lira, completely crash. That's political suicide. Nobody wants that. Option two, burn through their US dollar reserves. But, those were already dangerously low. Which leaves only option three, sell your gold to get the dollars you need just to survive. They chose survival. It is literally like a pawn shop for central banks. I love this analogy. Turkey basically walked into the global gold market with a massive chunk of its national treasure, 58 tons of it, and said, "What will you give me for this?" They swapped it for cash they desperately needed, all while hoping they could maybe someday buy it all back. It is a pure act of desperation. Okay, so that's the story if you're an energy importer in this crisis. But here's the crazy twist. The energy exporters are also in serious trouble. It's a totally different problem, but it leads to the exact same outcome, selling gold. And to understand why, let's use the analogy of a draining bathtub. So just imagine a country's financial reserves are a big bathtub full of US dollars. In normal times, the faucet is always on, right? It's pouring in fresh dollars every day from oil sales. At the same time, the drain is open a little bit, letting some dollars out to pay for imports and other costs. Simple enough. As long as that faucet is flowing faster than the drain, the tub stays full. But then the war hits, and it completely messes up this whole system. The disruption to shipping in the Strait of Hormuz, well, that basically turns the faucet completely off. If you can't get your oil out, no new dollars are coming in.
At the exact same time, things like military spending and rising import costs, they make the drain much, much wider. So now, that bathtub of dollars is emptying out at an absolutely terrifying speed.
Now, here's the kicker. A lot of these countries peg their currencies to the US dollar. That's a promise to the world that they'll maintain a fixed exchange rate, which is what keeps their economies stable. But to keep that promise, you need a massive bathtub full of dollars to back it up. If that tub empties, the peg breaks, their currency collapses, and you're looking at hyperinflation. So just like Turkey, they're forced to sell their other major asset, gold, to get dollars and refill that tub before it is too late.
So when we zoom out from these individual stories, you start to see the bigger picture. This isn't just one country with one problem. No, this is a perfect storm of forced selling. You've got at least 3 totally distinct forces, all pushing the price of gold down, all at the exact same time. First, you've got your energy importers like Turkey and India, who are selling gold just to pay their massive oil bills. Second, you have the pegged currency nations in the Gulf. They're selling gold to defend their currencies from collapsing. And third, you actually have countries like Russia and Poland who are actively turning their gold reserves into cash to directly fund their military operations. It's a 3-front war against the gold price. And if all that forced selling wasn't enough, you've got these other major headwinds swirling around. Check out this timeline. China, which has been the world's biggest official buyer of gold for years, has suddenly hit the pause button on its purchases. That removes a massive pillar of support from the market. Then you've got Russia. They were banned from the main London market way back in 2022, and now they're announcing export restrictions for 2026. This is basically forcing anyone who holds Russian gold to sell it now, before they get stuck holding the bag. So what you end up with are these 2 totally competing timelines. In the short term, everything looks bearish for gold. You've got forced selling, a strong dollar, high interest rates, all pushing the price down. But the long-term drivers for gold, things like the massive US debt, the fact that more money printing is basically inevitable, and this whole global de-dollarization trend, well, none of that has gone away.
And that leaves us with the ultimate question, doesn't it? Is this national margin call just a temporary storm that's creating a historic buying opportunity for people who actually understand what's happening? Or are we witnessing something much, much bigger? A fundamental reset of gold's role as a safe haven asset in the 21st century? The answer to that question is going to define the markets for years to come.